Why, hello there, and welcome to another episode of the Innovantage Podcast, where business meets tech to bring you your competitive edge. As always, I'm your host, Max, and it is my job and duty to explore that edge between business and tech and what it needs to happen between them to kind of coalesce them, to connect them, and to make them interact with each other. Today's topic is one that we haven't really directly touched before, but one that we have been touching indirectly. We are going to be talking about the founder market fit, how a fund or an investor or anybody that's looking to invest into a startup looks at a startup and what kind of things they are noticing and how are they selecting those kinds of startups based on a wealth of experience presented by Gytenis Galkis, who is the partner at Superhero Capital and venture capitalist and an advisor at numerous startups, and generally a pretty known quantity if you're trying to find investment in Lithuania. So, Gytenis, hi.
Thank you.
To the show.
Thank you. It's an honor to be here. Thank you for the invitation.
Thank you for taking the time to actually talk to us. So tell me a little bit about yourself for those of us that don't know who you are and what you do.
So I'm, as you well introduced, I'm a partner at Superhero Capital, and I've been investing in startups directly and indirectly through funds during the past 10 years. So I try to count how many, direct and indirect investments I have in tech companies and the ones I've reviewed or invested through the funds. And it's probably is close to 100.
Oh, wow.
So hopefully some converges to some good exits. Some already did. So that's, part of the process. But I feel well diversified in this specific category. Can't say that overall, but yeah. So have seen quite a bit of tech entrepreneurs in their pre-seed and seed stages.
That's very cool. Very cool. So I am familiar with the kind of the approach of investments that's based on diversification. That's one of the rules, right? You need to diversify your investments. You don't look for one startup that is definitely going to go to the moon. You are trying to find 100 that might.
Yes. You're actually looking for the one, but in order to find that one, you need to do 100.
So that creates a lot of processes for selection of those startups. And I know that you review hundreds probably every single year, or maybe even more than hundreds at this point. I really don't know.
So as Superhero Capital, we are looking at more or less, or the ones that we register in our CRM, that we actually have a closer look, is more or less 600 per year.
Oh, wow.
So if you take that, in a perspective of 10 years, that's 6,000. So, and there's also this indirect, you go to an event and there's 50 startups. So you kind of hear their pitches and so on. You just don't register because you register only the ones that are okay, more or less into your fund investment strategy and looks, at least on the high level, more interesting, to have a deeper look.
Yeah, so basically that's an already kind of filtered list with the next list of the funnel, right? And
exactly.
At the top of the funnel, you have a lot more startups.
Yeah.
So that's quite a challenging environment, I would imagine. How do you approach it even?
So over the years, like in the beginning, being younger, more enthusiastic, you would try to engage with every company, try to understand. But as you mature and grow, and the sheer amount of quantity also grows, so my trying to understand this, that's how part of this topic. A lot of people are talking about product market fit.
Yeah.
Product market fit happens at way later stage. Some people would say that product market fit is only at the point that when you have more demand, then you can actually produce and you're kind of cracking a bit. And where we are investing in pre-seed and seed stage, I think the key point is to look and understand the founder market fit analogy. And is there this founder market fit? And you can, of course, still be wrong. But if you're right, it's at least from my experience, you can be at least a bit closer to the winning outcome.
So can you explain a little bit more in detail what the product market fit is for people who are not in the startup world, and what the founder market fit is, and what's the difference between the two? So give us a little bit more
So
detail.
in my view, product market fit is at that point where you exactly know your selling value proposition, and your customers are able to come in to buy the product, and they understand what for they're buying. You already are not in this very early stage of early adopters, but there's already let's say a bit later stage of people joining in. There's awareness in the market, and people are just sucking in the product. So you could say, if we take what's recently well known as OpenAI and ChatGPT, yes?
Yes.
You know that they started working on the product in 2014 or somewhere around that time.
Yeah.
But we all, or the majority, started to hear about it in 2021, 2022. So definitely no product market fit in the GPT 2.0 and so on. And only at the third iteration,
Yeah.
we had this, oh, now it works. And then they skyrocketed like that. So that's, in my mind, product market fit.
Makes sense. Makes sense. And then the founder market fit in comparison?
And the founder market fit would be more of a theoretical aspect, I would say, because it's really hard to see it and then to validate it. Only product market fit eventually validates. But if you look in those two criterias, founder and market. So it's the intersection where you try to see if the founder meets the market that he understands and understands how to market his product in that market. So let's say if I'm doing something, I've been in venture capital for so long, and suddenly I want to build a company that does space tech without co-founders in the space tech industry. Do I have a product market fit, or or not product, but founder market fit, or will I need to learn every bit and piece of how to build, a satellite or whatnot?
Yeah.
So this is, is your team credible to actually meet the market that you believe? And do you have unique insights into specific market? And if you look more broader on yourself as a team, what advantage, not in Lithuania, not in the Baltic states, but globally, or at least in Europe, do you have as a team? Otherwise, maybe it's not a startup, or maybe it's not worth building, A good example in my head is Bill Gates. The story behind is that he went, when he was in his early teens, he went into this Lakeside High School, or not elementary school, like school in US. And that school had one of the first computers in the 80s, early 80s. And he had access to that computer, and he started learning, and he built the first timetable software for his school, gaining more access to that computer. Does that mean that, like in his teens, he already had a huge competitive advantage over anyone else because there was a limited amount of those computers, and he understood probably where the software and everything goes, how you can build systems out of the software, and how he could, build something for the masses.
Yeah.
So there's never overnight success, and that's where in market founder market fit, we try to understand, do they believe in this overnight success, or they have been working on a similar problem, similar industry, similar insight for at least the past 10, 20 years. And it can be, it can be in teenage years. If you had specific parents, who maybe were business people and you were close to the business when you were a teenager. So maybe in your 20s, 30s, you can actually build something very interesting. Or then maybe you need to be 40s, because statistically speaking, most successful startups, not the ones that we hear, because we hear only about exceptions, and the ones that are not exceptions but statistically significant, they are built by 40-year-olds. So they're the they have the highest likelihood of succeeding in the startup game.
Does that statistic like correlate with your personal experience?
In my view, yes.
Hmm.
And I always, like the hardest thing is you always see exceptions, and you always, start, oh, maybe I should have thought, but there are exceptions, and you need to try to understand them as well. But so far, the rule has been that more mature people who already know what is an invoice, how businesses work, who have relevant contacts, who know how to hire people, who know how to, train their staff and scale the business. They usually are the ones who actually methodically, build successful companies. And once in a while, we see, young people with brilliant ideas really having a very crazy insight into the market, and out of their sheer, energy, are able to learn very fast, and then they, grow even better than those, 40-year-olds, because when you have experience, you're kind of limited as well by your experience.
True.
And if you don't have that limits, but they are really rare diamonds. So it depends, If you can find one, probably you should invest.
Yeah. There's a saying. I don't believe it's translated to English very well, but I think it's in my mind somewhere in one of the languages that I know. So it's basically like, if only youth would have known, and if only the elders could have done it. So basically, if only you could have known what you know when you're older,
Exactly.
or if only you could have had as much energy as you were younger. I think the closest in English is basically youth is wasted on the young, where you have a lot of energy, but you don't have a lot of ideas that are actually valuable for that energy.
Practical knowledge.
Yeah, practical knowledge, indeed. So I guess that then creates that founder market fit in the end, right? If they are more experienced and older, that gives them a little bit of an edge in any particular industry that they are in, because they probably understand something about it if they've been in it for a while. But at the same time, like you said yourself, it does not make it a requirement. So how do you personally judge that fits? What do you do?
It's usually the conversation. It's usually the pitch deck. It's usually the conversation. So first, what market insight do the founder have? Or another, put it really bluntly and simply, why you or why is your team is the best is the best in the world to do this, and why now is the right time to do it. So maybe following with the few more examples. YouTube. Let's take YouTube as an example, as for the market segment. YouTube started, I think, around 2004, 2005, if I recall correctly. If you can recall before 2004 and 5, if you would like to download the movie, how long would it take?
A long time.
Yeah, I remember putting it overnight, and then you have a downloaded file, and then you can watch the next day.
Yeah.
So who would watch YouTube? Exactly. So you need the technological advantage. Another good example would be Uber. Here in the Baltics, we use more Bolt than Uber, but Uber as a flagship, they came after Lyft. Lyft was already there. There were some previous iterations and tries that failed, but at least in the books I've read and also thought about, there's more or less 5 reasons why Uber could have been launched. So one, we have this economical outset, which, after 2008, there was a recession. So Uber came around 2011. We had the first iPhone showing out in 2007. The iPhone or the smartphone started to having GPS, receivers. Yeah. But even before, we had to have satellites. Those satellites had to be open to public and have, positioning with the GPS. We had to have at least 3G connectivity in the cities for Uber to work. We had to have an app store for Android and iOS, and they should have been significantly, distributed among the population as smartphones. And then we should have in-app payments, and Facebook should have had, profiles already available to, connect with your profile and sign in and so on. So those 5, 6, 7 technologies, and some of them are deep tech technologies, had to be available for the market. For Uber, as an application, could say stupid simple, to actually connect the very missing pieces into an ecosystem and launch it as a platform. So that inside, how the world will look. What's the current cutting edge technologies and how they will shape the world? Now everyone's talking about AI, but most of the people are clueless how it will impact,
Yeah.
Are we moving, like if we look historically, are we moving from, 6 day work week to 5 day, now to 4 day, maybe 3 day? How this will impact the environment? How will people spend more on leisure, on conversations, on how in other words, how the world will change? And that's a very, very, simple question, but very hard to answer. And the insight is critical. So what are you connecting? And many cannot answer that. And you can feel from the conversation that they're trying to figure out it on the spot. And then, it's a pass. And some people, I would say, overestimate. So some products are highly marketing driven. Some products are highly deep tech and technology driven, but they, of course, also need sales.
Mm-hmm.
And sometimes I see a very big lag. There's business people that want to do something in the technology phase and they don't understand the technology.
Mm-hmm.
It's not a match.
True.
The team is not rounded. Sometimes there's good technology people. They believe if they create something great, everyone will buy and everyone will know about them. That's also not a match. So that's how you eliminate out of those 600 companies to some, 1-2% that you actually end up betting, and you are still not right. If your insight or the insight they have and you believe in is right. But sometimes you have those interesting companies that have the right or the insight that many believe is right, and then they become very competitive. And then you cannot get the excess return as well, because then you're competing and valuing the deal higher and not necessarily getting access to it. So the best cases are where the insight is non-consensus, but right. And that's where it's hard to actually pinpoint.
That's a very interesting point of concentration. And it seems very hard to do since you are focusing on pre-seed seed, so very, very early on. And there's not a lot of traction that can support the founder's ideas. So did you have any situations where you thought that the startup should succeed, but they didn't, or the other way around, where they should not have succeeded, but they did?
Probably, the ones should not have succeeded, and then you end up not investing, and then you regret. Yes, half of those, and yes, I have quite a bit of those where I believe that they will succeed, and I invested, and the outcome was not right. So yes, both. So yeah, I do have an anti-portfolio as well. Yeah. But and then you never know until it's someone buys them or they IPO.
Yeah.
But in my view, in many cases, even if you look in Vinted, back in the day when it was still Mano Drabuji, it was non-consensus, but they were right. If you look at Airbnb and read their story, they were far, far away from consensus. Everyone rejected them, and they, started selling cereal to actually sustain the business. Good marketing, good design, and they made it right, and it was right. And the ones that invested, because it was such an unconsensus deal, got enormous outcomes.
Yeah, well, hindsight is 2020, right?
Yeah.
It's always easy to kind of draw the road to success backwards once you're drawing from success. But when you're starting out and you're trying to find your own path, it's very hard to do. You've mentioned consensus versus non-consensus several times already. So can you explain a little bit more about that? What does that mean from an investor standpoint?
So from an investor standpoint, if you have a deal that is, many investors think that this is the deal of the century, then A, it will be very hard to get in. B, it will be priced closer to the market value. In the end, it's always, as an investor, as you trade stocks as well, you look for undervalued stocks that you believe will perform.
Mm-hmm.
Same with startups. But if, let's say, everyone believes that Tesla is the next big thing, the price adjusts very quickly, So that's exactly the same game, just you don't have less data points to validate, You don't have major banks evaluating the companies. You don't have people trading on the same. So you need to trust the vision, trust the founder's capability, evaluate what you have, do some legal due diligence, and then say go or no go.
Mm-hmm.
And since it's not public, then I think the main job of any investor, especially a VC, is to see and get access to as many deals as they can, and then make the right decisions. So I think a bad investor will have low access.
Mm-hmm.
Not sure about the decision making, because once you have a lot of access, then basically then you control your decision making. But if you don't have access, then you cannot control.
Mm-hmm. Mm-hmm. And the earlier you get in, of course, the better the deal, the larger the outcome.
Possibly yes, the more the risk. So again, everything is priced relative to the risk. So some people say you are overpaying when you do a pre-seed deal, at 3 million or 4 million valuation, because, you can buy at 4 million, already a working company that probably can grow 10, 20% per year. The others will say that you are overpaying when you do, a Series A deal at hundreds of millions. So it really, really depends on your risk profile and on your risk strategy.
Mm-hmm.
Some funds are they call themselves high conviction funds.
Mm-hmm.
So they say we do 10, 12, 7, 5 deals, but we need to be really highly convinced that this is a successful outcome, and we don't tolerate, non-successful outcomes.
Mm-hmm.
Funds like us, we believe more in the diversification. So better do more bets. So let's take a bit betting analogy, poker. So in poker, you have the flop.
Yeah.
So we invest, let's say, 500,000 euros because we believe there's a founder market fit. We invest 500. The cards open up, you start working, you see in a year whether there's some indication of product market fit or not.
Mm-hmm.
And if there's not, you don't bet again, you fold.
Mm-hmm.
If there's more indication that actually the company is tracking on the right path, they're growing significantly, the product is needed, you bet more. You see another card, and hopefully after another card, they have Series A or Series B. And that's, how I would put, in poker terms, how we operate in this pre-seed stage.
Okay, that makes sense. That's a pretty sound strategy, all things considered. The other type of strategy, though, that seems very, very risky, from an outsider's point of view. Like, how do you make sure that every single venture that you go into will succeed? How do you create an environment where non-success is eliminated completely?
I guess part of those funds have better access, or they work on the different part, they have access maybe to the potential buyers. Maybe they're already the companies then are more mature in that stage.
Mm-hmm, mm-hmm.
So they already probably have some value by themselves.
Oh, okay.
And then if you know who potentially is the buyer and you can control that outcome in a slight way, I don't know, again, in the contracts, then you probably can state that you are more high conviction investor, because in any case, you will be able to sell the asset.
Oh, okay. Yeah, that makes sense. So you basically create some of your own success.
In that sense, yeah.
You're not just trying to find the right solution.
Yeah.
You're just...
But then you usually also invest in way bigger ticket sizes.
Of course, that makes sense as well. And it's very hard to do so at the earlier stages, of course. But yeah, I feel that founder market fit is illustrated pretty well by that recent case of like one of the founders of OpenAI, or one of the kind of top people of OpenAI, that has created their own startup and has been founded by like millions, hundreds of millions, with an evaluation of billions already, without having like anything behind them. besides just that, I guess, that one conversation with somebody somewhere?
Maybe they have more. We don't have the information, but
That is true.
this is what you would call a consensus deal.
Yeah. So it is a consensus that they will succeed.
In my view, yes, because otherwise it would not be able to raise so much money.
That makes sense. That makes sense. But that's an exorbitant amount. That's just unheard of, as far as I understand, in the investing space.
And then you have also a very interesting case in Israel, Base 44, where a solo founder went and within, I think, 6 or 9 months, created a company that is similar to Lovable, where you can create, your website and web apps by just prompting. And he, for a very long time, was a solo founder. And it was just acquired for 80 million after 6-9 months by VIX, because they need such, product for themselves. Before the acquisition, he hired an additional 7 people and got acquired. So again, one-man show, and also going along, we'll see more and more people who are leveraging AI technology and all of that and building maybe not unicorns, but in a year, an 80 million exit outcome without investor money seems like an incredible outcome.
That's a pathway that's, I think many entrepreneurs would welcome to follow. Especially, I don't know how it is from your experience, but from my experience in the more boring type of business where you're bootstrapped and you're relying on your own funds to grow very slowly but deliberately. A lot of entrepreneurs are very kind of stressed about so many aspects of their operational day-to-day because there are so many of them. You have to think about finance, you have to think about sales, about marketing, about delivery, about office space, about so many different things, and they're always out of alignment of how you ideally want them to work. They're never perfect, and you hire people to help with that, and the people themselves are also never perfect, and you're always trying to find that balance between where you want it to be and where you are able to do it, and it just creates a lot of stress for the founder.
I would, maybe comment on this, that there's this industries, when we talk about the market.
Yeah.
Specific industries have this pool, if you're right and users really love and see your product, like you of course have to be visible and know how to market yourself, but once this virality effect kicks in, that's the beauty. Then you have such a big pool, towards yourself and the product, that everything just follows behind, and the other example is with some very good founders, very excellent founders, but sometimes it feels like they're shoving their product through the mouth to their customers. Not that the customers don't need it, but it's not on the priority number 1 or 2 or 3. It's somewhere in the 7. It's a good product. Everything's fine, but it's like a vitamin. We always forget to drink vitamins, but we never forget to drink a painkiller if we have the pain. So if you find the product and the market has a true big, like enormous pain, then it will just pull in. And there's this joke among maybe VCs, but the funny part, everyone's saying, we need to invest in an A team because A team will hire A team and everything will be great. But if an A team meets a bad market, the market will win. If a B team meets an A market, the market will win. It will have the necessary pool. It will pool the team. Probably there will be an outcome of some sort, not a unicorn, but an outcome of some sort. And if the A team meets an A market, that's where the magic happens. And I had the cases, excellent founders, like founder market fit is there, but the market is not there. the market pool is not there. Maybe it's too early. Maybe the value proposition is not right. The team, excellent, grows bit by bit, reiterates, so on. And I have where the market was good, it still is good. The founders are a bit lost. They're okay founders, but they're a bit lost, not hurrying too much, building it as a business. And you can see that the market is just pulling them, They cannot go bust because the market is just pulling them.
Yeah. That's That's a great way of putting it, honestly. Yeah, like the market always wins. And as an entrepreneur myself, I can definitely attest to that. Like especially when you're smaller and you're not in in any significant position to gain a market share in any significant way, you're just trying to get there. And you pull or push from the market is felt very, very directly in everything, and it can force your whole business to have to pivot it completely just because the market shifts like that. I think a lot of businesses felt that in Corona, for example, where you had your day-to-day operations that you're used to for like 50 years on day one, and then day two everything is completely different. The whole kind of ecosystem of the world is different, and you have to adapt to that very easily.
I think one also interesting example is that worth mentioning. It's when you look at the market and the founder needs to understand how to access that market. That's also sometimes very overlooked. And my example is, or what I try to, from those cases that you can read about and you can see, there's two companies. We know Tesla quite well. So Tesla started with the Roadster. A very strange car, very, very expensive based on Lotus base. 100,000+ euros for EV, which you cannot charge, which had so many errors. The battery would charge fully, but the regenerative brakes there would be no offset. So the brakes would not work if the battery is full, and many interesting things. But it was marketed with pre-sales, and it was marketed to affluent people or very rich, high net worth individuals that believe in the cost of electrifying the future. So then you actually attest to crazy people who just believe in your cause. And many startups need to do that because they're innovating. Same with OpenAI, in the beginning, it's rough product. It's not a polished diamond.
Yeah.
So you need to work with someone to bring it to life. But the example, another company, many have not heard of it. It's called Better Place. It had billions in funding, or close to $1 billion in funding. It was based in Israel. It had an agreement with Renault Nissan, an Israeli government, to electrify Israel. Renault produced almost 1,500 vehicles with swappable batteries before Tesla. And it flopped. It flopped because the market was not ready. It went directly to the mass market. Renault Fluence, electrifying the full nation of Israel. And people are not ready yet to transition to that. They don't trust the technology. We don't like change. And I think Tesla went very right, They went with very rich people, then affluent people with the other models that were also very expensive, but bare. And only then they went to Model 3 and Model Y, which now is affordable by everyone.
Oh, yeah.
And that take them almost 15 years or 10 years to go to this point. Whereas this Better Place went, let's go to the mass market, and sometimes it doesn't really work if the technology is not there.
Yeah, that's an interesting example. I haven't heard of it before, but it makes complete sense. Yeah, like even when you have a perfect product, but you're at the right place, even maybe, but not at the right time and not with the right audience, everything just falls apart.
MySpace.
Yeah, MySpace. Yeah, indeed. There's this famous example in business calls where they always talk about them as like Kodak invented the first digital camera.
Yes,
so
indeed. That's also, going into that, Kodak and Nokia and all of that. Yeah. So Nokia also had the first smartphone.
Yes, they did. They were the king of phones in the world, and they invented the first smartphone, and they lost all of it.
Because the insight was right. They just didn't believe it. Non-consensus.
Yeah. So then coming back to your 600 startups a year, how do you select for them? So we understand the founder market fit, right? But is there some more to it? Is there like a system that you look for in pitch decks maybe, or any specific things that you...
I'm more open-minded than that, than, just focus on the deck. But like first question, do I believe in this founder market fit? Does the story actually connect? and then do I see a relatively good risk-reward profile.
Mm-hmm.
So if it's overvalued, probably it's not for us, or let's see later. And then you try to adjust. But I think the main criteria is there this founder market fit, and then the risk reward profile.
Mm-hmm.
So that's, I think, how we more or less made our last year's eight deals.
Okay. Makes sense. And what goes into the risk reward profile aside from the things that you mentioned?
Do I believe the deal is overvalued or not? Do we, as a relatively small fund, can we acquire at least 10+%? Or maybe not in that sense, but in a different sense, to put it really bluntly. So if we have a 50 million fund, can this outcome of buying either 10, 20, or 5% return us the full fund within a period of 7 to 10 years? So because since we, as I mentioned, do 30 investments, we understand that with this risk profile, 25 will be probably written off or just return the initial investment amount. So those five need to return the full fund. So if we buy, at the 50 million fund, invest $1 million and buy 1%, what's the outcome that it needs to generate? Not even half. It has to be a 5 billion outcome.
Mm-hmm.
What's the likelihood in an early stage that they will go into 5 billion outcome within a year, or not a year, but 7 years?
Mm-hmm.
The likelihood is probably closer to zero than to some meaningful percentage.
Yes.
So then it's a no. But if we can buy 20% for $500,000, and then maybe buy a bit more as we go along, to protect our dilution in the next round. And then we can exit at, 250 million with 20%. It will also return the fund. And the likelihood on a good growth path, they will be at that outcome is way higher. So what we, understand, we of course would love to have a unicorn. That will be a, total game changer for us as a fund manager. But we position to our LPs and to ourselves that we're okay in having, 5 outcomes between 100 and 500 million. And that will be totally fine. We'll generate the necessary returns to our limited partners, to ourselves as fund managers, and be a good fund that is able to raise the next.
Mm-hmm. Mm-hmm. Yeah, okay. That's a very interesting system. Yeah, I honestly can't even comment on it because it's so far outside of my own field of being, so to speak. But it seems balanced. It seems like a sound strategy where you're not overreaching by betting on too many things and hoping for something too abstract. But at the same time, you're not so conservative where every single penny of your fund is so stuck in due diligence that it's unmovable and unrealizable. That's a very, very interesting balance.
Moving back to poker analogy, we would not bet on 2 and 7,
Okay, yeah, that makes sense. I think most poker players shouldn't bet in that situation. That's true. But there are some situations where you have bet and the bet failed. And before this recording outside of the cameras, we talked about the Sintra case, something very famous. Relatively, I guess, famous in Lithuania and in the Baltics as well. And you told me that you had the chance to invest into Sintra, but you didn't.
I'm not sure if it's a chance, but we had the conversation, at least probably we could have tendered. I'm not sure if the money would have been taken by the founders, but we could probably have been tendered. And as you mentioned, retrospectively, it's always easier to look. So yes, I think my personal conviction was not there and it was wrong. So I also, for my own justification, I was making another deal that was $1 million deal at the same time and just became a partner at the fund. So maybe 2 million deals would be a stretch. Maybe my cojones are too weak for that, but overall, yes, I think now looking back, they made significant progress. It's an interesting product. I love the design. The founders are seems to know what they're doing. So I'm really happy they were able to get the funding round in place and keep on growing. So kudos to them. And that's one of, I can put them in the anti-portfolio category and then see what happens. I had some companies in the anti-portfolio company that we intended to invest and could have, but didn't find an agreement. And that eventually raised significant Series A rounds and then beyond.
Mhm.
And ended up going bust, 3 years in. But
Yeah, sure.
in that process, I was tearing, oh, why didn't we invest and so on. So I'm kind of in those 10 years also matured enough to not tear my hairs apart in that, but trying to learn, what did I spot? The problem is that every time they change a bit.
But there must be something that you learn maybe from every kind of the significant mistake that you missed, right? There's something that you take out of it and learn for yourself.
Yes. Yeah. But it's so different that it's hard to, put into a specific system.
Mm-hmm.
But that's probably, where we should, as a fund, embrace more of this, data-driven approach and document bear. And that's what we are trying to work with the CRM as well, how we document decisions and how to improve on those decisions. And but again, in the early stage, it's a lot of, I would not say emotion, but personal story. And reading through that personal story, can they deliver? When have they delivered? How did they came about that insight? And why do they believe that why should I believe that the market, have this pull? So, you can Google or ChatGPT or do your market research on the competitors. It doesn't show anything. There can be tons of competitors and still you can, actually make it.
Mm-hmm.
So sometimes it's in this early stage quite useless. But understanding if there's a drive, and the passion, and 24 and, Revolut.
Yeah.
Why Revolut is success and then 24 is a moderate success. It's still a success, but compared to Revolut, not so much.
Yeah.
So probably founder drive, passion, and, many other things, culture. So how to evaluate for that?
I think many would say there's a lot of luck involved. Like you just have to be lucky as an entrepreneur sometimes.
I would partly agree, but partly disagree. And I have one case that I learned that as well. The story would be this, or the morale of the story, you have to be definitely prepared when luck strikes.
Mm-hmm.
So this one company is in a very interesting market that is growing rapidly. And very young founders, relatively young, so without that, big business experience, but I think they found a very interesting market.
Mm-hmm.
So I ended up first time rejecting, second time investing. And before my investment, they came to one unicorn offering their products, or they were tendered in the process, and that unicorn customer was selecting from several vendors.
Mm-hmm.
And basically, if they would have not been selected, most likely they would be out of business. So you could say they were lucky that they have been selected, but they were prepared as well. So they danced, drank, whatever needed, and offered the system and the price that won the tender compared to the other 2 or 3 companies.
Mm-hmm.
And you could say luck. I would say preparedness and luck. So, and then since then, within 2 years, they grew like 70 times.
Oh, wow.
So mostly driven by that unicorn customer, which you could say as well, in the general business practice, it's very risky to have one customer. But if you grow significantly, suddenly number 2, number 3, number 4 comes in and you're more legit. You have already proper business operations, you have the budget, you have everything.
Yeah.
And then you can offer, make it out into a very proper business. So yes, luck is needed. So there's this joke with, before AI, maybe with AI now, that an assistant brings to the CEO a pile of CVs, you know, and he looks at those CVs and throws half of the CVs into the trash bin. And this assistant, why did you do that? I don't want to deal with unlucky people. So that's then it's definitely luck. Otherwise, you need to be prepared.
Yeah, I agree with you there. It's definitely, again, there's one saying that I forget the complete wording of, but basically, like, luck is when consistency meets work or effort,
Yep.
basically, right? So you create luck by creating the environment to pounce on any opportunity that comes your way. And from my experience in business, there's always some opportunity coming your way. There's always something you can leverage, but you have to be, like you said, prepared to actually make something out of that opportunity. In our business, for example, it's kind of a mosaic of many different smaller things that kind of connect together. So you have to have different pieces that can fit together. Like, for example, if we do a service on, I don't know, like creating data platforms for mid-sized businesses somewhere in, I don't know, in Benelux, that's our main region, right? Somewhere in Belgium, for example. So when a client comes to us and he tells us that, okay, I want to create a data platform for, I don't know, for my school or a series of private schools, for example. I have a lot of students, I have a lot of teachers, I have a lot of parents, and they have a lot of data, and I need to kind of protect it all with GDPR and blah, 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 blah. And I have this rigorous selection process that I will only work with a company that has done something like this before. So if we have done the groundwork of, creating a case study for something like this, then we move forward with the deal. And we may or may not get the client, of course, but we at least, we can pounce on the opportunity. We have that asset, a very simple one, that helps us move forward. But in the other case, even if we did have that experience and we can say that we have done something, but we didn't invest the time or the resources to create an asset out of it, then we probably would not have moved forward. And it's a very rudimentary, very simple example, but it happens all the time in all the places of the business. So there, I definitely agree with you. So maybe what kind of advice maybe you can give to aspiring founders and founders looking for funding, maybe in the pre-seed or seed stages? What should they do in order to stand out? How they can project that founder market fit a little bit better?
Focus on the market inside. Focus on where the world will move, So, are you betting? You should bet on how the world will change, and you might be wrong. You might learn new things, but it's all about betting into the future. If you would think that the internet, dial-up connection will stay constant, then you would never invented YouTube because it's too long, too hard. Same as with Netflix. Like Blockbuster had an opportunity to buy Netflix back in the day, and still refused because they didn't believe in development of internet and TV and all of that, and television per se. So you have to have this unique insight of how the future looks, how the technology develops, and that's hard. That's actually hard. No one has the crystal ball.
Yeah. From my experience working with those earlier stage founders and startups, I'm not super experienced, right? I've been doing this for like 15-ish years, but not for decades upon decades. But I've seen a few things in my day. And what's interesting that I've noticed is that some founders are talking about such niche and specific things, such interesting insights about some markets, that if I were put in their position, it would take me like years to learn. And I understand that okay, like if I am to compete with that kind of a founder, not that I want to, but if I were to put in a position to compete with them, then it would take me just years to be on the same level of knowledge as they are. But they don't consider that as insider knowledge. They're like, well, yeah, that's that's just, everybody knows that. There's no point even talking about it. That's just obvious stuff. And then they focus on something completely indifferent to the actual insights of the market. So I feel that a lot of founders that have that insight, for some reason, are underrepresenting it or just don't know how to present that insight to somebody else. I don't know. Is that something that you see, or is that only my
Sometimes it
observation?
is, but that presentation of the insight of the market is part of the job, and if you cannot explain, what scientists and very, very bright and smart people is that they present it in a very difficult language.
Mm-hmm.
And then it's hard. There's probably an opportunity,
Mm-hmm.
but someone needs to find them and make an opportunity out of them. So, also maybe reflecting both Steve's job and Wozniak, a great duo.
Yeah.
And from one book I read that Wozniak was obsessed with developing and drawing processor or those boards, circuit boards, and because he could not afford the computer back in the day, and he was just drawing them. And by drawing, being obsessed, he always thought of how to optimize and make the design of the board better and better to reduce the cost, and one day to build it, with high performance capabilities, but without all the components. So mentally, he was obsessed about that. And then Steve had the other, Jobs had the other view, on the marketing side, on the how usability, how good design should look. And that combination, brought Apple to life. And as well, there's in that book, it was written that Jobs agreed with Wozniak that Wozniak will not need to manage any teams because he just didn't want to. So he wanted to be obsessed in this. So this is, that's why really hard and really non-consensus is to invest in solo founders, because then they have to cover all those pieces by themselves. Or probably then if you are a solo founder, then you need to have the capability of hire talented people that complement you and understand your weaknesses and have a very, very strong delegation, advantage. So when we look in this founder market fit, the founder team complementing each other. So the number one mistake when I ask, so how did you meet together? Why did you form this team? Oh, we high school friends. Most likely this is not a good case. Because
which one is a good case then?
Done some projects together, met through projects, complementing skills, if it's a marketing product, but high, on technology. So how a marketing person met the technology guy, whether it's through past work experience, whether it's from something else, Some of the good cases was that the business guy worked on a different startup that failed, but the delivery or worked in a company and the delivery was outsourced to the guy who's been delivering, their IT infrastructure or system or whatnot. And that's how they build the relationship. And after 4 years of that relationship already working together, they went for a beer and looked into a market insight of some sort and convinced and started building something in that range. So there has been a work or business relationship in the past, framed, a bond, framed an understanding on the market, and both are committed to doing something new.
Oh, well, that makes sense. That makes complete sense. Okay. Then before we end, I wanted to touch a little bit on the whole ecosystem as a whole in the Baltics. So we are not, super well known in Europe. If you're a young startup that you're looking to raise money, you go to London. That's where you want to be. Because why? Because it's big, because all the money is there and blah, blah, blah. And if you are just, talking about startups and you're just hearing about startups, even in our conversation today, we've mentioned Silicon Valley a lot. That's where the biggest cases come out of. That's where the biggest projects are, and that's where the most money is. So how do you feel, what's kind of characterizes the ecosystem here? Like, is it a big one or a small one? Is it, has it reached its potential already with a niche, or is its potential somewhere in the future? So do we have like fits in the kind of startup markets, or are we still searching for it?
It's such a small ecosystem. I think we are a small ecosystem. All the Baltics, even combined with the Nordics, then we are bigger, but we're still relatively small if you look at the big countries. The good thing that each of the countries more or less try to have its own niche, so it's really hard to be a generalist in such a small ecosystem. But I think also we need to look at what the government is doing, and the government program on back in 2017, I think, with becoming a fintech hub worked really well, and we are still seeing the dividends and had exits in that area. And many good companies like Mambu and SumUp and others came to Lithuania to establish their hubs as well here. So I think we are doing a lot. Our GDP growth is among the best in Europe, if not the best. Our purchasing power is growth as well, is among the best in Europe. So we are doing many things very right. The only, I think, main limiting factor for us is how can we attract more talent, and how can we increase the birth rate, thinking of future. But in the end, that's all about talent. So a lot of people, in the US, which we speak a lot, so movement of labor is way more fluid. And that's what we don't have really in Europe. We can cross borders, we can work in different European countries, but because of the culture, because we are more settlers, maybe in that sense, it's not the same country. It's harder to cross borders, to start living in Lithuania from Italy, moving back, and so on. So, but this is part of where we need to establish ourselves. I personally studied in Copenhagen and Denmark. And what I loved about it is that they offer free education and even some bonuses on top for European citizens. So ends up, we were 7 Lithuanians in the same course. Half stayed, half left, but they stayed. They learned Danish. Some, even those who left, learned Danish. And that's, how the influx, comes in. They work in very known big companies in Denmark. They contribute to the GDP. They pay off. So I think we're only talking about the educational system, and it's never the priority. Of course, now the priority is defense, but if we have, need for talent, we need to attract them. And probably we can attract through either education or high-skilled quality jobs, but then it's harder because people are already, settled in with families. And for students, it's easier to move. And then find roots in the new city.
Indeed. Plus, our salaries in this part of Europe are not the highest.
Exactly.
Not yet.
Still not Denmark.
Still not Denmark. Not very close to Denmark yet. House prices are still not Denmark though.
As well, yes.
But we are getting closer.
Some actually things are more expensive here than in Denmark.
Like what?
Like flowers.
Oh, that's a weird one.
Yeah.
That there's so much vegetation here. Tennis is
more expensive.
Oh, yeah.
There are things that are way cheaper in Denmark.
Okay. That's good to know. That's good to know because my wife loves tennis and she plays a lot, and I see it by the amounts of bills. Like, oh my God, why is it so expensive?
Exactly.
You're just playing with the ball. Why? But yeah, I can agree with you on that.
Definitely. I guess infrastructure, it was built back in the day. So
Probably. But speaking about infrastructure, that's also a very important one. I feel that's the Baltics specifically in our infrastructure, especially like high-tech infrastructure, are doing pretty well. So, internet coverage is a very basic one. Yeah. Access to technology, like laptops, computers, phones, whatever. Like it's so, I wouldn't say cheap, but so easily available that, when you're competing with somebody I don't know, outside of the EU, for example, they have a much harder time.
I think even within the EU,
Even within the
Spain,
EU.
Italy, Greece.
Yeah.
Mm.
Hey, even London, every time I come to London, I'm so frustrated because the internet basically does not work.
Mm.
The internet sucks in London. And even before you go into the underground, and when you go into the underground, you basically have no internet in, well, not everywhere, but in a lot of the lines they have there. And I'm so used to having great internet, like 5G almost everywhere here in Lithuania, where like I'm going to the forest just to hike and I can easily, have work calls with 4K quality, and that's just the norm. And then I'm again in London and I can't even have like a normal chat message because it's always delayed. And I'm like, what the hell?
Yeah. So answering to this,
Yeah.
I think this is the Nordics per se. This is the best place to build. There's Vilnius is super cozy. I think the other cities are also very nice. And tech infrastructure is there. People are here, so why not build here? I think this misconception that you have to go to Silicon Valley. Yes, for Series A, Series B, if you can, you have to go there. You need to build a global product. But if you do pre-seed, who the hell are you, for them to be able to fundraise there?
Yeah.
Or maybe then you live there for 10 years, or maybe, you have worked in Tesla, Meta, somewhere else, then you have the network. But if you have been building here in the Baltics or across Europe, why would they trust you? Or even if you are such a great company, then validate it through growth, or at least validate through good investors that come from the region. It's slightly, yes, the world gets smaller. There's more and more VCs that look at the metrics on how you grow, and probably there will be more cross-border investments as we go to the future. But for now, it's still a bit of the people business. Who can you shake hands with? Who do you trust? And then it's all about trust. You cannot convince to sell your business as to your clients, but an investor has to believe in you, your team, your capabilities to invest $1 million, $500,000, $2 million into potentially what will be the future. So probably today you still need to meet in person, to shake hands, to spend some time. I'm sometimes joking that an average first marriage in European Union is 7 years. And lifetime is 10 years. So if we make an investment, most likely it's for a 10-year period. So we will need to stick around for longer. Of course, we don't meet every day, but
that helps.
That helps, yes. But still, if you have this feeling that it's not, something is off, that maybe I don't tell the truth, you don't tell the truth, that there's this tension, then you as a founder need to select your investor the same way as the investor needs to select the founder.
Yeah, that makes sense. That I wanted to ask one more question on top of that, but I forgot what I wanted to ask. No matter. So yeah, I agree that there is a lot of what's going on here in the Baltics, and I see honestly some startups from other parts of Europe coming here and pitching here. They're kind of sporadic for now, but even in my kind of business world day to day, like I see some people and they're like, yeah, I've heard some nice things about Vilnius. There's Vinted, there's like there's other kind of smaller startups that are still out there, and we heard a lot about fintech, and we heard a lot about digital government and so on and so forth. And it would be interesting to come and see. And then they come and see, and they see kind of the environment. They see like Startup Lithuania. They see like Lead Ban or whatever, and they see real people, real startups, and they shake hands and they do business together, and that makes sense. And I wouldn't say that I am a big fan of the strict, metric-driven approach. I am leaning myself more towards that person-to-person stuff, because that's just how I'm used to doing my business, and that just makes more sense in my part of the world. I definitely can understand investors who are just looking for traction and just invest on, sure bets, so to speak.
Not sure if it's sure bets, but it's in a way preparing for the age of AI or age of data.
Yeah.
So the question is, what will we people do if we outsource this everything, to computers? And they probably can find better deals than we as humans, with our limited data analysis capabilities can. But on the other end, people will still want to do something.
Yeah.
So some of the jobs will remain just out of sheer pleasure, even if Tesla or Waymo automates, cars, full self-driving cars, I would still love to drive, some retro gasoline-driven V8 or V12. It's pure pleasure,
Yes.
And then for that piece, I think people will still, do some business, but the enjoying part of the business. So maybe that's actually the relationship building part.
Yeah. That's a nice sentiment. And you always have to remember the fact that markets are not always driven by logic.
Oh, no.
So there's a lot of...
not.
Mostly not. Mostly not. There's so many meme stocks nowadays that are driven by nothing than just human sentiment.
Scientists have a term for that, behavioral economics. So it's about, fairness, behavior, and all of that. So FOMO and...
I can definitely see the top stock somewhere in the future being the one that AI considers to be the worst one by every considerable metric, and everybody just pumps it up just by the nature that just, giving the middle finger to AI. Like, nope, this is going to be the number one stock. We're going to spend all of our hard-earned money on that because AI thinks it's bad. So there's definitely future for people, I hope, at least. So yeah, I guess that's more or less covers it. Thank you very much for finding the time and sharing your expertise and your insights. So where do people find you? Where can they reach out to you if they want to?
On our website, I guess the best, on LinkedIn, so superherocapital.com, and my personal LinkedIn, so feel free to connect and follow and engage if you're building something and you feel that you have a founder market fit.
Nicely said. Nicely put.
Thank you.
So thank you. And thank you all for tuning in and for listening to us. So if you believe that you have the founder market fit, feel free to reach out, and don't forget that you need to really kind of argument it, explain why here, why now, and why you. And maybe you will be the next unicorn, maybe even the first one who was done by one person. Regardless, like, share, and subscribe to our YouTube channel. Leave your comments below of what you feel that we've gotten wrong or right or whatever, somewhere in the middle. And stay tuned for more episodes in the future. Thank you very much, and bye-bye.
Bye.